Hello and welcome to The Upside. I'm your host, Emily Ananuevo. Coronavirus, or COVID-19, continues to raise health concerns around the world as the number of infected cases rise. The novel coronavirus is a new strain of coronavirus that has not been previously identified in humans. The virus causes a range of symptoms, from the common cold to more severe respiratory effects. The virus originated from mainland China in the city of Wuhan. Coronavirus has rocked the global markets, and investors are anxious for updates about the economic impact of the outbreak. So we want to help you cut through the noise. In this episode of The Upside, we have two interviews from our Fidelity team members who will provide some perspective on the impact of the coronavirus on the global markets and potentially your investments. Fidelity is a global company with boots on the ground around the world. So first up is Yeung, Investment Director of Equities in Hong Kong, with an exclusive Asian market perspective on the virus situation.
The current environment regarding the coronavirus is that of a very fluid nature. We're seeing markets, since markets did reopen after Chinese New Year, generally trend higher. So investors are wondering whether this is your typical late cycle complacency view, or indeed has much of the negative news flow been priced in. So what exactly should investors be mindful of? When we look at the number of cases per day, the mortality rate versus previous epidemics, it does look quite high. More recently, we did see a spike in number, but the reason why we did see this higher amount of cases coming through is due to a change in methodology. So diagnostic changes, given that historically or over the past few weeks or more recently, a lot of the hospitals in China had run out. There are predictions that we're beginning to see a number of the cases peaking, a number of the mortality cases peaking. I guess the next potential black swan, and this has been a black swan event, is if we see a massive increase in cases both inside of China as well as globally. From a Hong Kong perspective, and if we cast our minds back to 2003 with the SARS outbreak, so the severe acute respiratory syndrome, Hong Kong, in terms of the infrastructure and policy, is quite adept to dealing with this kind of situation. The majority of the borders between Hong Kong and China have now been closed, and whilst we are still seeing growing number of cases both here and in Singapore, again, the expectations are for containment and for these numbers to start to come down. So I guess from a market perspective, if we were to see a vaccination come through, mass production, vaccinations being provided to the patients, immediate treatment, so to speak, and also diagnostics being done, you could see the markets propel even further. What is key, though, is returning back to work. Over recent weeks, we have seen a delay in production and manufacturing, not just across your typical technology sectors, as well as, for example, materials, but a vast array of subsectors. Even online delivery has been delayed given the lack of truck drivers. So, whilst we are beginning to see factories resume production, it's not to their full capacity, especially the larger names or the larger factories. And the risk is, if we do see a delay going into second quarter, this will then hurt second quarter numbers. In regards to first quarter earnings and economic growth, investors should be mindful that we will see lower numbers, although again, this is probably being very much factored into current market prices. Across the region, from a policy perspective, since Chinese New Year, the Chinese policymakers and authorities have really cracked down in terms of containing the virus, implementing easing measures. More monetary and fiscal easing is expected to try and really support and underpin growth. Across Asia, central banks such as in Thailand and the Philippines have also eased by around 25 basis points each. Across most of Asia, we are seeing interest rates in positive territory, some countries at historical levels. And with inflation being relatively benign given lower oil prices that we've seen year to date, this allows central bankers to provide further easing if it is required. If we look at China in particular, the strong returns we saw in both 2018 and 2019 were very much propelled by a handful of names. These names were high growth, had good earnings visibility, and are very well-known names for investors, both foreign and domestic investors, when it comes to the China market. However, going into the end of last year, you started seeing some investors beginning to rotate into other areas of the Chinese market, small caps or your value-orientated sectors. So the risk for those more growth-orientated managers with a large cap bias to those Chinese names was that 2020 could indeed see this rotation away from those well-favored names, which were then trading at very high multiples. But in fact, the outbreak of the virus has seen investors who are still exposed to China or who are getting into the Chinese market once again gravitate towards those high beta names. It's basically become the defensive way to play the Chinese market versus your traditional defensive names. So, for the value names, for the small cap names in China to outperform or once again see some traction, what does it take? Probably for the virus to be contained, for the market to fully price in the first quarter disappointing numbers as a result of the virus, and for a pickup to be done by growth, underpinned more than likely by easing policy, again, both monetary and fiscally speaking.
Next up, Fidelity portfolio manager Ramona Persaud explains how she's managing her portfolio in a rapidly evolving situation. Now, these clips are from a previous episode of Fidelity Connects, our advisor webcast, where Ramona speaks to host Pamela Ritchie about the potential impact of coronavirus and how investors should be prepared.
If I can just be human for a minute, lots of people are being infected and dying. Mortality rate, it looks kind of high relative to certainly a normal flu. So that's quite sad. It's possible that you have to separate the market into its constituent pieces again. So the US market, not so affected, European markets, but at one point the Chinese market was down quite a lot. Travel stocks were down 25%. The entire Chinese market was down 8 to 10% in the course of a couple of days. So that's a big impact. But as we sit here in the Western world with the luxury of greater, better healthcare systems where we don't necessarily have to worry yet about pandemic or this becoming endemic, I think that shows up in some amount of market differences in market reactions depending on where you're sitting. So for me, what's awesome about that is being a global investor. I also have US funds. I can only invest in US companies. And if that's only down 1 to 2%, that's not a whole lot, but I get volatility all over the world depending on what's happening. And so with the Chinese market down 8 to 10%, I'm able to then go look at travel stocks down 25% and look at luxury companies that are starting to get squishy in terms of their valuations. Or a big beneficiary of this virus is plasma companies. The demand for plasma, blood plasma, will go up or is higher, and it was already in a imbalanced supply-demand situation in an oligopolistic industry structure, which is great for pricing, so therefore great for profitability, free cash flow of these companies. So there are things across the world. I think taking a global perspective helps me to just find opportunities. Definitely a lot of history from health data, and what's cool about this insurance analyst is he went through, the New England Journal of Medicine and the Lancet and all these things to get some statistics, and you can make some estimates about if it does become endemic and there's not a vaccine, so a lot of nested probabilities, then it could be a flu that's sort of 10 times as bad as a normal flu in terms of fatalities in the US. And if you've got that much fatality, how much does it hit GDP? So the estimate that's out there is probably a 4 to 5% hit to GDP, global GDP in like a kind of bad scenario. But here's the thing, I'm kind of an engineer math person. When you nest that many probabilities, it becomes not that useful. You need so many things to happen in series, and it's multiplicative. So meaning to say the uncertainty factor is really high. So as an investor, the way I think about that is there will be parts of the market that get really freaked out about all those nested probabilities and sell off tons of stocks, like sell off tons of things like Chinese travel stocks down 25%. And maybe parts of the market that will have more apathy or won't be as sensitive to it. And my job is not necessarily to think about what will happen because we can't predict it, but to sense when the sell-off is overdone. So for instance, a grocery store that's still getting traffic in Taiwan, but maybe the Taiwan market is freaking out about the coronavirus coming there, so everything sells off en masse. That's really interesting to me. The key message is that there is a lot of uncertainty that we've had, certainly if you're looking specifically at the Asian market. There's probably a fair bit of uncertainty to come. What that means is that you'll get a good amount of market volatility, and what that then means is you'll get pretty big disconnects between price and value. And you should be ready for it. So what I'm doing is having all of my buy lists ready and my sell list, the things, the super defensive stuff that everyone will crowd into because it's safety. And I'm just waiting for it. So I think the key is uncertainty, volatility, patience, be ready.
Hope you enjoyed this episode of The Upside. Now, if you like the show, we would love it if you gave it a like. And please visit Fidelity Canada's YouTube page for more of the Upside content. Thanks for watching, and I'll see you next time on The Upside.